Alrighty, in today's video, we are going to be going back to our sources of finance and looking a bit more in depth at debt and equity. So where you can find this on the syllabus, under planning and implementing, there is a section that looks at debt and equity finance, and we need to know what are the advantages and the disadvantages of each. And this is going to be really important for things like higher order verbs like assessing sources of finance or evaluating sources of finance or recommending sources of finance, and obviously discussing sources of finance. So those kind of higher order verbs is where you'll see the syllabus dot point. And often if you get a business report or a short answer question where you have to recommend a source of finance, you'll have to give reasons for that recommendation. And so the advantages and disadvantages comes into play there. So let's get straight into it. The advantages of debt financing, remembering that debt financing is when you are borrowing money from some sort of financial institution or other business that's offering that finance to be loaned to you. Also, in general, with debt financing, you have to pay interest on them. But the good thing about them is that you don't have to sell any shares of your business to get that money. But debt finance is quite difficult to source. So in general, our advantages, as I said before, is that you get to maintain your ownership and control of the business. And this is because you're not selling any shares. You get the money without giving up some of the ownership of the business. So that's really good. It doesn't get diluted down. Also, interest repayments are tax deductible for businesses, and tax deductions help businesses to have more money in their pockets. So we can say that interest repayments being tax deductible equals higher retained profits if they decide to keep them, or higher profits in general to shareholders. That's the good part about it. And the reason why they are tax deductible is because as a business, any cost or any sort of expense associated with doing your business operations or investing within your business is a reason for tax deducting. So if, as a business, you've bought a new car because you want to do deliveries, part of that will be tax deductible. If you have to buy a new factory to produce your good or service, you can't tax deduct the whole factory, but the interest repayments, which is the cost associated with getting the money for that factory, does become deductible. Loan funds are often easier and quicker to obtain than equity funds. And in businesses, we're all about efficiency and ease of access. And if most businesses, if they already have a really good credit rating or relationships with companies that loan money or financial institutions, then they can very, very quickly get the money, set it all up, and they'll have the source of funds ready to use, especially if there's some sort of opportunity that awaits. Equity funds takes more time because you have to either issue a prospectus if it's a new issue of shares, you have to set a price, you have to make sure your financial statements get audited, they have to actually go on. You're not even guaranteed that people will buy the shares. So loan funds in that sense are a lot easier. Also, loans provide a business with the opportunity to grow. So that's just in general an advantage of a source of finance altogether, really, because if you take loans, they help you to buy things that will help your business to grow, whether that be machinery or equipment. And also, you don't have to share the profits with the lender. So when you give equity and people buy shares in your business, you will then have to, not necessarily, but you should issue dividends to them. So you share some of your profits. Whereas if you get a loan, you pay interest. Yes, that's the cost of borrowing, but you don't have to give part of your profits as well. And once you pay off your loan, then that's it. You don't have to give any other money to that lender. Now, some disadvantages associated with it are the initial establishment costs and ongoing fees and charges. So there's a lot of admin fees that are associated with loans and just fees of establishing it that a business should take into consideration. Obviously, the biggest disadvantage is interest. You don't just get to borrow the money for free. You have to pay interest back as well. So there's a cost associated with borrowing money that can increase over time. So especially if you've gotten a variable loan where the rate can change and it's not fixed, then your interest repayments can increase over time. And if you don't make sure that you pay back every month or every period when you make repayments, if you don't pay it back, all the interest plus some of your actual loan money, then the loan's just going to actually keep growing instead of going down. Repayments are often fixed and inflexible, so it's very hard unless you have a certain scenario that you've discussed with your bank, but it's really hard to break out of your repayments. Once it's in the contract, then you can't really get out of it. They're very fixed. You have to repay the amount in a set period of time, so you are limited in that case. So that puts pressure on a business to earn as much money as possible and make sure that they can still make those repayments in time. And also it increases our gearing, which can affect their solvency. Now, just remember that gearing is all about your debt to equity ratio. So the more debt you have, the more highly geared you are, and then that will affect your ability to pay back your debts, and businesses don't want to be in a situation where they can't repay back their debts and are really highly geared, because it could lead to business closure. So when it comes to the advantages of equity financing, there are many of them, namely that you don't have to repay the money back, and you especially don't have to pay back with interest. So when you borrow money through selling shares, essentially, or when you sell shares, you don't have to pay back the shareholder that money. The only thing that you do have to give them is dividends, or give them some of the profits. That is a disadvantage of it, but there still is no mandatory nature associated with dividend payments. Whereas when you borrow money, you have to repay it back and you have to pay interest. Equity does not do any of that, does not. Now, owners receive returns through dividends, which is great for them, but not necessarily for the business. But what actually is an advantage of the business is the fact that it increases share value. Now, increasing your share price value really doesn't have much impact on the business. It impacts investors more because they can sell their shares in the future at a higher price and make some sort of profit. But what an increase in your share value insinuates, or the implications that it does have for the business, is that if you increase your share value, it leads to an increase in the demand for your shares. What that means is that if you want to raise more money or raise new funds through equity financing, it's a lot easier to sell shares because there's a higher demand for it. So businesses who want to invest in your company, as soon as you need to raise new funds and sell some equity, they will buy them straight away. Or your current investors who already have shares and are getting some sort of really good dividend payment, and they're really happy that they're investing in your business, if you decide to issue a share purchase plan, then they will be more likely to quickly take you up on that and buy more shares in the business because you've increased your share value over time, and that's because you've been increasing your dividend repayments. So that's a really good benefit. It just makes it more easier to source money through equity. Also, there is flexibility in dividend payments. In other words, it is not mandatory. So you don't have to give dividends to your investors. It's not mandatory. For example, now with this whole COVID-19 situation, many companies are not actually giving dividends to their shareholders because they don't have that much profit. They need to retain as much of it as possible to cover the costs associated with it. It's not mandatory, but a business does want to make sure they're giving regular dividend payments for the reason I've just stated previous to this one. The other advantage of equity finance is that when you have an invested interest in a business, you are more likely to undertake actions that will help the business to succeed or help the business to grow. Because if the business grows and succeeds, as an investor, you will be getting more profit. So this is especially related to private equity financing, because if you own a certain amount of equity and you have interest and you want the business to do well, you will do everything in your power in order to do that. And that could be really good for the growth of the business. And finally, Equity financing also lowers your gearing, and that decreases your risk. So remembering from previously, gearing is your debt to equity ratio. The more equity you have and the less debt you have, that means that your business is relatively safe. There's less risk associated with it, and there's less risk associated with becoming insolvent because you don't have to repay back any money. And lastly, the disadvantages associated with equity financing is that it increases the number of owners and the level of control. So the more shareholders you have, the reduced level of control, and also you have to increase how much profits you're sharing. So the more equity you have, the more of your profits you have to distribute to your shareholders. Also, like I said before, when you sell shares into your business, those owners also get voting rights, especially for major decisions. So in order to actually make a really big decision in your company, you'll have to actually hold some sort of annual meeting, and you will have all the shareholders having to make a decision or vote on what you would like. Shareholders obviously expect higher returns. So they're expecting that you are going to give them dividends. So that's related to dividends. And equity can be quite hard to obtain because it is a lot more timely and expensive to organize. Like I said before, you have to issue a prospectus. You have to actually announce that you're going to be issuing new shares. People might not necessarily buy your shares. There's a whole bunch of other hurdles that you have to jump over to sell equity. It's not tax deductible, so once you get the money, you get the money. You can't really save on tax. There are also legal and administration costs that are quite high associated with organizing equity financing, having lawyers, accountants, auditors, etc. And the other thing is, once you open up your business to people buying shares, it's not just everyday people buying shares into your business. It can also be other companies. And so if you are opening up ownership, it could potentially open you up to takeovers. So businesses buying more than 51% of your company, actually taking over and taking majority ownership. And then you'll lose control of your business, and it all goes downhill from there. So there is a bit of risk associated with that.